How your bank is stealing from you. In today's complex financial landscape, many consumers may feel that their banks are not always acting in their best interests. While banks provide essential services, certain practices can lead to significant financial harm for customers. From excessive fees and unauthorized account openings to predatory lending and identity theft vulnerabilities, there are several ways banks may exploit their clients. Understanding these practices is crucial for consumers to safeguard their finances and ensure they are treated fairly by their financial institutions. Here are 7 key points detailing how banks may be stealing from you. Number 7. Excessive fees. Banks frequently impose a number of fees that can seriously deplete a customer's funds, such as overdraft fees, which are assessed when a customer takes out more money than is available in their account and can vary greatly, typically costing between $30 and $40 per transaction, and can mount up quickly if a number of transactions take place in a short period of time. Monthly maintenance fees, which are charged when customers use ATMs outside of their bank's network and can amount to several dollars per transaction. And monthly maintenance fees, which are frequently applied to accounts that do not meet certain requirements, like keeping a minimum balance or completing a certain number of transactions per month. Additionally, some banks could impose inactivity fees on accounts that are inactive for a long time. Number 6. Unauthorized accounts. Unauthorized account creation has been a major problem in the banking sector and has given rise to grave ethical questions regarding corporate governance and consumer trust. In order to reach tough sales targets or receive bonuses, staff in high-pressure sales settings at banks may open accounts without the agreement of customers. This practice not only violates ethical standards, but can also have severe repercussions for affected customers. If these accounts are left unnoticed, people may find out they have been charged for accounts they never authorized, which could result in unforeseen fees and issues with their credit reports. Moreover, the emotional impact of discovering unauthorized accounts can lead to anxiety and distrust toward financial institutions. In order to make things right, customers may need to spend a lot of time contesting charges and coordinating with credit agencies to get bad marks removed from their credit history. Number 5. Predatory lending. For customers looking for financial support, predatory lending practices pose a serious risk, especially for individuals who could be in precarious positions or do not have access to typical banking services. By providing loans with outrageously high interest rates and hidden costs intended to keep borrowers in a debt cycle, predatory lenders frequently target people with bad credit histories or those in immediate need of money. Payday loans, for instance, can have annual percentage rates APRs of more than 400%, which makes it practically hard for borrowers to pay back the loan without taking out more loans to pay off prior obligations. This cycle can cause borrowers to struggle to make payments on several high-interest loans, which can result in serious financial difficulties, including bankruptcy or foreclosure. Additionally, harsh collection tactics are frequently used in predatory lending practices, which can worsen the borrower's financial and mental health. Number 4. Internal fraud. Customers who entrust their banks with sensitive information and assets run the real danger of suffering significant financial losses as a result of internal fraud in banking organizations. Workers who have access to customer accounts may use their jobs for personal benefit in a number of ways, include conducting illegal transactions covertly or altering account balances. Because it frequently involves trusted individuals who are acquainted with internal procedures and systems, this kind of fraud can be especially challenging to detect. In certain situations, banks might not have strong internal controls or oversight procedures in place that could stop fraud from happening or from staying undiscovered for a long time. Consumers might not become aware of fraud until they see irregularities in their account statements or get notifications about odd transactions they did not approve. Internal fraud can have disastrous results, both monetarily and emotionally, for victims who feel that a reputable organization has betrayed them. Number 3. Identity theft. In the current digital era, identity theft is becoming a more common problem as fraudsters employ increasingly complex strategies to get bank accounts and personal data. Phishing scams are popular techniques used to fool people into disclosing private information like passwords or social security numbers. Phishing scams involve attackers posing as trustworthy organizations through emails or messages. Once fraudsters have this information, they can open new accounts in the victim's name or drain existing ones without the victim's knowledge or consent. Identity theft has serious consequences. Victims frequently experience large financial losses and have to work through difficult procedures to repair their credit and get back money that has been taken. Furthermore, as people deal with the fallout from such breaches of their security and privacy, the emotional toll of identity theft can result in chronic stress and anxiety. Number 2. Manipulated interest rates. Manipulation of interest rates by banks can have dramatic consequences on consumers' financial responsibilities without adequate prior disclosure or justification. Because banks can alter interest rates on variable rate loans in response to internal rules or market conditions, borrowers may find that their monthly payments increase dramatically if interest rates rise without warning. The amount of interest that customers receive on their deposits can also be impacted by changes in savings account. Interest rates' lower rates result in slower growth over time for savings meant for future objectives like retirement or educational costs. For borrowers who depend on consistent payment amounts for budgetary purposes, this volatility may cause financial strain. Abrupt increases in payments may cause missed payments if borrowers are not ready for the changes or upset carefully thought-out budgets. Number 1. Lack of transparency. Customers may become perplexed about the terms and conditions pertaining to their accounts and services due to the widespread lack of transparency in many banking institutions. Banks frequently offer long contracts that are rife with legalese, hiding crucial information about fees, interest rates, early withdrawal penalties, and other matters that could have a big impact on consumers' financial choices. This opacity can lead customers to unknowingly agree to unfavorable terms or incur unexpected charges due to misunderstandings about how products work. For instance, some savings accounts may have tiered interest rates based on balance thresholds that are not clearly communicated up front but could drastically affect earnings over time. Additionally, rather than being clearly communicated to impacted customers, changes in terms like fee structures or interest rates may be conveyed through fine print hidden in lengthy documents. You can protect your finances by being aware of tactics like predatory lending, unauthorized accounts, and exorbitant fees. Being aware and alert will enable you to hold financial institutions responsible and make wiser judgments. Keep in mind that your money should be handled with dignity, therefore do not be afraid to challenge your bank's policies and look for alternatives if needed. Thanks for watching our video, and don't forget to subscribe.